there is another aspect of it, and that is that if you save in gold and you release gold in order to spend, then your spending habits change quite radically.
Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Friday, March the 27th, 2020. And I have the very distinct honor and great pleasure of welcoming back someone to the show who has taught me an enormous amount about the precious metals, gold and silver, and how they interact in our lives and in our society, and the importance of holding them for a multitude of reasons, not just for the protection of purchasing power, but for various aspects of our lives. And he is someone who I hold in very high regard and very high esteem. Love the way he thinks, and the way that and the research and analysis that he does is second to none, and I mean that sincerely. And he is the head of research, and I'm speaking for Gold Money, and I'm speaking of Mr. Alasdair Macleod. Alasdair, welcome back to the Daily Coin.
That's very much my pleasure, Rory.
Well, I'm so glad that you're here, and I sent you an email about the crack of dawn for me this morning and asked you if you wouldn't mind jumping on, and you were gracious enough to do so. And I wanted to ask you specifically about your formula, your FMQ, the fiat money quantity formula, because we've just had these just truckload after truckload of money printing beginning back in September with the repo madness, and then the unleashing of the 2 trillion by the Federal Reserve. We've got quantitative easing going on all over the place again. There's just fiat. It's like a confetti party all over the world again. And what is the FMQ telling us? And if you would give the people just a brief description of what it is, first of all.
Yes, certainly. The FMQ is what the Austrian economists call true money. And that is, it's the sum of cash, deposits, checking accounts, and a few other accounts. And to that, I've added the money that's actually held on the Fed's balance sheet to produce a fiat money quantity, because, of course, not all the money is in circulation. The money supply, when you look at M1, M2, Austrian money supply, and so on, is always looking at money which is in public circulation. I just want to capture that slightly wider scene by including money that is not in circulation but could become in circulation. So that obviously includes the bank reserves on the Fed's balance sheet. That's basically what it is. And I don't know to what extent it will reflect the current expansion, if you like, of the quantity of money. Obviously, it's just going off the charts.
Yes.
My problem with it, with FMQ, is that I can only get the data about six weeks in arrears. So it is yet ready to show much more than a bit of an upturn at really almost a record pace, which was the figure for, I think, January and February. And that was really, as much as anything, I think, the result of the repo madness, if you like, that started in September. But I think in another 2 or 3 weeks, I'll be able to get the March figures, and then we'll see it ticking up quite strongly. But in any event, you don't need to look at the statistics. We know what's going on, and basically it's print, print, print. Everywhere.
It's insane. I mean, it's like these guys woke up one morning and collectively lost their minds and said, "Okay, the ship's going down," and that's the bottom line. We're firing on all cylinders, and nothing else matters. We're just, like you said, we're gonna print until the machine breaks. I mean, where does this thing end? I mean, as far as the $2 trillion package that Congress here in the United States just signed off on, and they're still working out. I think they're still working on a couple of details, but for the most part, they're just going to start handing out money. Not money, but fiat currency, I should say.
Oh, indeed, and they haven't started yet. I mean, that's just
Right.
the warm-up act. The biggest problem, which nobody can really see, is the missed payments in the production chains.
Mm.
And to try and quantify that, you don't look at GDP and say, well, GDP is roughly what 22 trillion or something. You look at gross output, because gross output takes in all the payment steps from starting with a basic, a number of basic products and services which you put together to produce a final product. All those payments just in the United States total roughly $40 trillion. This is called gross output.
Mm.
$40 trillion, that doesn't include the element of production chain abroad. In other words, you get an awful lot of stuff which is semi-manufactured and then imported. Things like Apple iPhones, their chain goes out into China, into Taiwan, into Korea, South Korea, Japan, and I don't know, wherever they've got factories. And you've got inputs going into these people. Now, if you have a problem with the sales of a product, then the people down the line just don't get paid in the way they expected. So what happens? The ones which have actually got money in the bank start drawing down on the money in the bank to pay their costs. The ones that don't have money in the bank go along to the bank and say, can we borrow some more money? And then, they really are testing the old theory about banks. They'll offer you an umbrella when it's nice and sunny, but when it's raining, they take it away from you. Will that happen to them?
Mm.
The overall effect of this is that because the banks are now, they now perceive huge, huge risk. We've gone from a situation where banks were quite happy to lend money to expanding businesses. You get a nice young guy walking in with a brilliant business, brilliant idea, etc., etc., etc. Bank wants that business, and they have salesmen in the banks talking to these people. Now it's changed. It's completely changed. They see risk everywhere they look. They see risk, and of course, on the deposit side, the businesses which actually have cash in the bank, they're drawing it down. So you can see that one side of the bank's balance sheet is contracting, which is on the deposit side, and the other side is trying to increase. So what do? I mean, the pressure on the bankers to reduce their obligations is absolutely enormous, partly because the pressure is coming from the deposit side. So getting back to the point as far as the Fed is concerned, the Fed becomes the lender of last resort for all these production chains through the banking system to a degree, yes. But then there's something called Section 133, subsection 3 of the Fed, the Fed's founding legislation, which, if enacted, allows the Fed to lend money direct to corporations. I wouldn't mind betting that the Fed is going to have to do that. They'll have to do that with people like Boeing,
Yes.
General Motors. All these companies that have huge, huge liabilities. And all this is happening at a time when the debt levels, corporate debt levels, are just absolute record. So, as far as the Fed is concerned, I get the point about the coronavirus and all the rest of it, and the immediate problem that things are shutting down for hopefully a matter of no more than a month, or maybe 6 weeks at most, sort of thing. Well, dream on about that. But the real problem is the payment failures in the whole of the production chain in the American economy and in the economies that feed into the American economy.
I want to stop you right there, Alasdair, because you have unpacked an enormous amount, and I want to look at the how all of this, or what all of this means to the American citizen, or to the citizens of London as well, or the UK where you're at, and how is this going to impact all of us? I mean, are we just going to wake up and the Federal Reserve is going to own all of these corporations? Because I'm pretty sure that they have enacted that Section 133 subsection 3, and they're not only have they, I believe that that's been enacted, but I believe that they are using the ESF, the Exchange Stabilization Fund, in order to carry that out, in order to make that happen. And then that is as I'm sure you're aware, the ESF, the Exchange
Mm.
Stabilization Fund, is under the sole discretion of the Secretary of the Treasury of the United States. And that
Yeah,
currently is Steve Mnuchin, former Goldman Sachs
yeah.
uh, vampire squid. But it's so what does that mean to the corporations and the home that people own? I mean, because if the Fed buys all of these corporations through their quote loans, then all of a sudden everything, the Fed, the banks basically own everything. Or am I wrong?
Well, I don't think that is the intention. I think the intention is to bridge finance until things recover. But the problem I think that we have here is that the Fed thinks that this is a problem of a virus, full stop. And when the virus goes, the problem will go with it. In that, I think they're being incredibly hopeful because the credit cycle was already turning down, having been in the expansionary phase for the last 10, 11 years. So we are due the regular contraction phase of
Okay.
the credit cycle, which inevitably happens very quickly, and it creates systemic risks, and banks fail, and all the rest of it. I mean, the last one we had was the Lehman one, and we know how upsetting that was. This is very, very different, I have to say. But the idea that it's just sort of the coronavirus and it'll go away, and really what the Fed is doing is bridging a financial problem, I think is looking at it completely from completely the wrong end. Now,
Hmm.
having said that, the problem, I think, the underlying problem in all this is something that has been accumulating for a very, very long time. And I do remember Alan Greenspan, when he was chairman of the Fed, saying, in all innocence, about puffing up the stock market by printing money. He was saying, well, with a high stock market, you increase confidence in the economy. Full stop.
Right.
That was what he said. Now,
Nope.
this this has been going on and on and on. So we're now in a situation where the Fed has committed itself entirely to printing money just to keep the valuation of financial assets as high as possible.
Hmm.
Now, the most important one is not the stock market, though obviously that's what Greenspan was referring to, and certainly in terms of you know the ordinary person, the man in the street, if he's got investments in the stock market, he is very concerned about that. But the really important one is government treasuries, and the U.S. treasuries are valued on the basis of zero interest rates. One, secondly, a rate of price inflation which is under its target of 2%. But if you go and talk to John Williams at Shadow Stats, or you talk to the Chatwood Index, you have got two independent methods of managing methods of assessing the current rate of price inflation. And they both come up with the same answer. It is approximately 10%. So if you were to value the US Treasury market on the basis that price inflation is looking like undermining the US dollar by 10% per annum, what price do you have then for the 10-year US Treasury? In the existing market, you've got to be looking at a price of about 47 cents on the dollar, as opposed to a dollar on the dollar. Now, if you get a move in US Treasuries of that extent, it's just going to completely mess up the US government. I mean, the debt will be completely unfundable without massive printing of money. I mean, the only way it can be done is through primary dealers, with primary dealers taking the stock in accordance with the rules and the Fed printing money to pay them to buy it off them at the rate which the Fed sets. But I mean, that is going to become even more inflationary. And so what we're looking at is a situation which last happened 300 years years ago was a Scotsman called John Law, who went to France and managed to persuade the Prince Regent that he had this wonderful scheme to pay off the royal debts, which were, if you like, the equivalent of the country's debt, and at the same time make everybody happy. And it was called printing money, which is what he did. And the first thing he did was he set up a bank, which he then managed to turn, with the Prince Regent's agreement, into the Banque Royale, which was in effect a prototype central bank. And he also had another little business, and that was something which we today call the Mississippi Venture. And the Mississippi Venture basically included all France's overseas trade. I mean, the whole lot, not just in the France's interest in what today is the United States, but in the West Indies and the East Indies and everywhere where France had an interest. We're talking about 1719, late 1719. And what he was doing was he wanted to merge the Banque Royale with the Mississippi Venture, and in order to do that, he was puffing up the shares of the Mississippi Venture by printing money. Now, this is exactly what we have today. We have a situation where we've been issuing currency in order to sustain asset prices. And so, I mean, this is just John Law. Now, what happened? The outcome of that was that the purchasing power of his livre started noticeably declining in November, December 1719. The merger was meant to happen on the 28th of February 1720. And unfortunately, the king decided that he wanted to take some money out of this. So he agreed to sell 100,000 shares at a discount to the market price. And that the market price was about 12,000 livres. The price at which this chunk was going to be sold was 9,000 livres. Paid in stage payments, admittedly, so it didn't appear to be too much of a problem. But you can see how, with a few people taking profits, and also quite a few of these shares had been sold on a partly paid basis, and payments were coming due. And rather than stump up an extra payment, if you like, people were tending to sell the shares into the market on a partly paid basis. So the whole thing started stalling.
That's called a Ponzi scheme, isn't it?
It is. Well, it is. It's a variation on the Ponzi scheme. Anyway, the lesson from this was that by September 1720, the shares had some notional value. They'd fallen to about 1 or 2,000 livres. But the purchasing power of the livre had fallen to zero. They were completely worthless.
Wow.
So literally, in less than a year, they went from John Law being the toast of Paris, the man who fixed everything, sorted out the royal finances, got the economy going, but there was a little bit of inflation happening, beginning to mount up, and a poor harvest didn't really help. But who cared about the peasants, sort of thing? We got the same thing, same attitudes today, incidentally, in Wall Street. But anyway, I'll pass on that. We went through all that in less than a year, and we have got exactly the same experiment today, except it is called neo-Keynesianism. But they're doing exactly the same thing. So my firm forecast is that paper currencies will collapse completely by the end of this calendar year.
It's funny. I'm sitting here when you started with those dates of October 1719. It's like, well, that sounds very familiar. And then you said September of 1720. It's like, well, when you said 300 years, you meant exactly 300 years. I mean,
but that's just coincidence. That's just coincidence.
Well, but it fits perfectly with Neil Howe and his co-author of The Fourth Turning. It fits perfectly with the fourth turning concepts and ideas. Fits perfectly with that. So it's pretty scary, and I'm going to have to say, you folks, if you're not looking out by the end of the year for something major to happen, then good luck with that, because it sounds like everything is lining up exactly for that. And in the meantime, I want to kind of shift gears, Alasdair. That concludes this portion of the conversation that I had with Alasdair Macleod, and look for part two within the next 24 hours, and that will be on gold. And in the meantime, you can check out all of Alasdair's work over at wealth.goldmoney.com, and please come over to thedailycoin.org, where you will find a plethora of up-to-the-minute news from around the world. Thank you so much, and we will talk with you soon.